He knows. He's forgotten more about this than I know.
Stan?
Well, I was surprised to hear Steve not mention the term financial conditions, because Bernanke didn't specifically open with interest rates. He opened with financial conditions. And it's my understanding, last time I checked, the stock market's at an all-time high, and it's up, I don't know, 200%, whatever the amount, it's up over a number of years. And the way the Fed calculates financial conditions, I read a piece this morning, and it's probably accurate. It fits my intuition that financial conditions are actually slightly higher, according to the Fed model, now than they were in June. I don't know whether that's true or not. Someone else wrote it. But certainly a stock market at an all-time high would suggest that we don't have a problem with financial conditions. I was surprised. Look, I don't really care about surveys. Those people aren't betting with their real money. The big money was betting that they were going to taper. Otherwise, gold doesn't go up $50. Right. The dollar doesn't get killed. That's stocks don't go crazy. I agree with Paul Gigot article this morning. I think they lost their nerve, and I think it's the tragedy here is I think they had a freebie. They had they had telegraphed tapering. It was in the market. They could have started the process, get us off the dope. It wouldn't have cost them anything because it was in the market. And to me, they blew it. And the problem here is when you look at what happened in June, okay, to the financial markets, the first response to this is going to make it so much harder for the next chairman to start the process than had we not been through this fiasco the last 3 or 4 months.
So to the extent that one of the tools in the toolbox is communication and this whole transparency argument, do you think it's been a mistake?
Oh, I don't believe in transparency. Jimmy and I were talking earlier. I was at Pittsburgh National Bank in 1979, pre-cell phones, pre-CNBC, all this stuff. I wake up and I'm managing money. I wake up one Sunday morning and the Fed has raised rates 200 basis points the night before on a Saturday night. Paul Volcker, to me, the greatest Fed chairman in history, broke the back of inflation, set up a period of long-term growth. Bundesbank ran their operations the same way. Transparency has led to more volatility and more confusion. Look at what just happened with this forward guidance stuff. They were trapped by their own dots that you guys have outlined the last few days. They wanted to be transparent on forward guidance, but then, oh my God, if you take what their own forecasts spit out, Fed funds are supposed to be 3% in 2016. So now what do? I'm with Volcker. What you do is you just stop all the talking and do your job like he used to.
Sam, I know you watch once in a while, but I've been saying over and over, like this narrative that we've heard from the Fed. Well, we're going to slowly start to taper, and then unemployment will be at this point down to 7, and then it'll be heading to 6.5. GDP by then should be 3 to 3.5, and it's this beautiful little story. But we've had a 5-year recovery already. There's no way they know the future about whether it's going to go as planned, which is going to allow them to exit. And my biggest fear was that the economy doesn't cooperate, because it hasn't. You saw their previous forecasts are nowhere near where GDP is supposed to be. So how do they ever get out if the what if it doesn't? What if we get an uptick in unemployment? Or what if they can never justify getting out based on the economic fundamentals? Do we need $85 billion a month forever?
Look, my concerns with QE are probably more well documented in the press than I would like. I had a little press tour 4 months ago for other reasons and made some comments about the Fed. Let me just sort of crystallize what my concerns with QE are. First of all, I'd like to say that QE1, when we had dysfunctional markets and we're facing a meltdown, I thought Chairman Bernanke, what he did was creative, what he did was courageous, one of the boldest, more effective moves in the history of the Fed. And I can't think, given the intellectual capacity, where he came from, I can't think of a better man and a better American to do the job he did with QE1. So let me first of all say, I think Chairman Bernanke's been a great public servant, and what he did with QE1 was just phenomenal. Having said that, I believe QE is an extraordinary measure that should be used at extraordinary time. Dysfunctional markets, potential meltdown. And I didn't even agree with QE2, but as you pointed out, Joe, we are 5 years into a recovery. The stock market has gone up and up and up. We're not talking about zero interest rates here. We're talking about $85 billion a month. And I don't think the academics at the Fed understand the unintended consequences of the potential exit. Yesterday, the chairman was asked about whether this would complicate the exit, and incredibly to me, he suggested it wouldn't. Can you possibly say what went on in June, where they hinted that maybe if the economy is strong for 3 months, maybe we might do a little taper? You saw what created. Can they possibly think by adding $85 billion a month to their balance sheet, and frankly, to investors' balance sheet, and I want to make this point, the exit is not going to be harder. And on the two balance sheets, everyone focuses on the Fed's balance sheet, $3 trillion, and the problems that creates. Don't forget there's another balance sheet, and that's the balance sheet of us in the market that sold them the bonds and were forced into the risk assets they're so desperate to have us in.
Right.
We have been forced into prices of securities at subsidized prices. And when those subsidies are removed, whenever that is going to be at some time in the futures, those prices will adjust as shown in June, and they will adjust immediately, and they will do it on no volume. I had an old boss in Pittsburgh who we used to talk about stock manipulation. It takes hundreds of $1 million to prop a stock up. The minute the earnings report comes out, all that money is wasted because it reprices. This wealth effect they've been using to prop this stuff up, once that's removed, you go down on no volume, you reprice, and I will bet from beginning to the exit, the wealth effect of QE will have been negative, not positive,
Okay, so
negative.
Explain this to me then. Yesterday, and it looks like today, the market will be up. I don't know if it'll end up, but clearly up. Should bad news be bad news? And if you think that the Fed, this is really bad news, and is this just a short-term pop in the next week or two? Investors
Oh, no,
are gonna see
it's
your
not a
way.
short-term pop. First of all, as a practitioner in markets, I love this stuff.
Right.
Okay, this is fantastic. It's fantastic for every rich person. This is the biggest redistribution of wealth from the middle class and the poor to the rich ever. Who owns assets? The rich, the billionaires. You think Warren Buffett hates this stuff? You think I hate this stuff? I had a very good day yesterday, okay? So anybody who thinks that Friday we get Summers is out,
Right.
okay, 20 minutes before the Fed meeting, a White House official leaks it's going to be Yellen, and then we learn 20 minutes later it's going to be Yellen without tapering. Anybody who thinks financial markets could possibly have adjusted to that equation in 72 hours is crazy. This is very bullish for markets, but is bullish for markets intermediate term.
Right.
All this stuff I'm talking about is long term and really
And
not
real
practical
economy.
for a money market practitioner.
mean-
I think when I was on your show in March, I said we were in the 7th inning in a 4-year bull market.
Right.
I thought we'd about done by now. We're going into extra innings, baby. The punch bowl was running out.
It's a twilight
it was just about
doubleheader.
dry, and 2 waiters just came in, and they're carrying this new
Yeah.
punch in.
The doubleheader.
We're going to really party now.
Yeah.
Kids. No, the reality of it, it's very good for guys like Stan, and to a much lesser degree, somebody like me. It's bad for my children, his children, and the guys that caddy for Stan and me. That's what that's really bad for. The economy is not where they would hoped it would be. It doesn't, I mean, obviously Bernanke, I think it's the worst thing long term for the economy, because he's saying this is much worse than we would have thought, because he did have a free pass to do it. Right. Now, he's supposed to be alone by himself, not affected by anything, tone deaf to all this, and that would be good. But I just can't imagine why they wouldn't do it. Just start it. I mean, the hangover is going to be worse from this. But
They won't cut entitlements. They won't touch them. We're going to continue to cut food stamps. We're going to cut Head Start. We're going to cut NIH grants. It's pretty amazing what's going on here.
You had a really incredible statistic that I was reading through early this morning about what we're paying seniors right now versus what we're expecting the kids who are about to be born to pay.
Well, this is a number I've been looking for about a year and a half, and this organization that I've helped out a little, the Can Kicks Back, commissioned Larry Kotlikoff, who I think I mentioned on your show back in March. He's the #1 generational accountant in the country. He's a professor at BU, and basically the number is as follows. If you are an average 65-year-old, you will have benefited by receiving $327,000 more in benefits than you paid in. And where is it?
300,000
327,000.
more in
Yeah.
than what you take out.
Now there's assumptions here, so maybe it's
Right.
300,000, maybe it's 350,000, but this is the guy taking his best shot at it. But if you are an unborn, you're going to pay, based on current benefits and tax schedules, you're going to pay 425,000 more than you get out. So current seniors are going to get 700,000 more than future seniors, and somehow people don't have a problem with that. I mean, look at the stuff we're cutting, and these people are untouchable. And you know, everybody says, well, the seniors wouldn't give that up. I think if the seniors knew this number, I think they would give it up. I don't think they want to do that to their grandchildren and their great-grandchildren. I really don't.
And I don't know, we're worried
I
about.
agree with you, but I think it's so hard.
Well, you got
think it's-
to.
Why is it
No,
hard?
look, I agree with you 100% that if you look at the numbers rationally, it'd make everything you're
Stan,
saying makes sense,
this
but
is-
everybody ultimately is so selfish
Ultimately.
and so short term
This
that
is-
it's very hard.
But this is the same guy that came up with the actual unfunded number that we don't use. Some people, what they say, 70 or 80 trillion, and what is he's
No, if you take, so
What's
Joe,
our promise?
everybody here pays a payroll tax, right?
Yep.
If you think about it, what that really is the government is borrowing the money from you and promising to pay it back later. So it's an off-balance sheet debt of the government. This guy took his best shot at this. If you brought that onto the balance sheet, so if you took the future revenue stream according to scheduled taxes and scheduled benefits, and you netted out the present value, the current debt of the country is not 16 trillion as advertised, it's 200 trillion.
200.
Yeah, now
Some
I don't
people
know
say
whether
70 or 80. but-
Again, there's assumptions in there.
Right.
Maybe it's 180, maybe it's 220. It's a heck of a lot more than.
But look at you look at the way this shutdown is being portrayed by mainstream media as if it's just so unheard of to even talk about these things. Like no one wants to hear it at this point. And the people that want to deal with entitlements are losing the PR war with the president.
Well, part of the reason they're losing it is they're focusing on the debt. I think we got to focus on the unfairness of this.
Right.
A statistic, Becky, that you may have seen that I sent you earlier.
Yeah.
If you go back 30 or 40 years ago, the percent of federal outlays spent on children and on the elderly was the same. It was about 20%. That number over the last 30 or 40 years has gone to 50% for the elderly and 15% for children. I mean, think about that. And that's where we are now. And if you look forward, the next 10 years under the federal budget, according to CPO, we're going to grow $1 trillion. 875 goes to Medicare, Medicaid, and Social Security. 6 goes to children. 6. Wow.
You were saying that we were in the 7th inning of a bull market. What do you think now, though? You said extra innings?
Yeah, I think, again, what happened in the last 4 days is extraordinary. I think it's going to extend things. You got to love gold here. I mean, when you look at a potential Yellen Fed and what just happened with the inability, in my opinion, to ever instigate any serious tapering unless there's something really extraordinary going on. I mean, maybe this trickle-down monetary policy that gives money to billionaires and hopefully we go spend it is going to work, but it hasn't worked for 5 years. So I'm afraid of, Joe's implicit question earlier is, how do we get off the dope? We just had the greatest opportunity you could ever imagine to get off it, and we didn't pull the trigger.
Would you, if it had been Summers and if they had done 20 on the taper, would it be positive for gold? I would think that would have been
No,
be on the other side.
gold would have gone down.
Down to 1,200. And now,
The facts change, you change your mind, Joe.
No, I
And
know, because yesterday morning I've got people say, "Hey, nice call on gold," and it's like the call, and that wasn't my call. It was that you would think
was
that if they
Blankfein call.
yeah,
Right.
and Goldman's call, but all bets are off.
Well, no. Everything I have said about my concerns about QE, that's as a citizen, and that's a long-term thought. As a money manager and as a wealthy person who deals in markets, this is great for me. I don't think it's great for America, but I'll tell you what it is great for. It's great for gold. And on an intermediate basis, it's great for risk assets. At some point, it will end. 2000 ended. I don't know when this will end, but I think the risk reward is pretty good here for risk assets.
For how long, though? I mean, you said it won't. That's the game, right? The game is figuring out when.
I don't know.
So what do you-
Luckily, I'm not managing a huge hedge fund anymore, and I'll be able to change my mind when I decide.
The bubble can't be as big as we already had, though, could it? The housing bubble. I mean, we've learned something.
I don't know how far they're willing to go.
So we could reflate to the same size.
We weren't buying $85 billion a month in the mid-2000s. Monetary policy was too loose, but we weren't doing this stuff. Where's the emergency? Where's the crisis? Why are we spending $85 billion a month, adding to the eventual exit problem? And again, of two balance sheets, the Fed balance sheet and all the stuff the public got sucked into.
Stan, thank you for being here. This was
Thank you.
terrific. And do come back and call us when you do change your mind.